Welcome back to Jacksonville's Retirement Coach. I'm Kacey Biddy, and each week we get the chance to sit down with Jacksonville's own Adam Wolf, the founder of Wolf Retirement Navigation, and our go-to guru on all things retirement. Adam, great to see ya.
Hey, Kacey, how you doing?
I am doing well, and I'm super excited to get into the show today because we're chatting about something that sparks a lot of questions and strong opinions, and that is Roth conversions. What are they? When should you do one? Is it even the right move for you? That's what we're going to dig into today. So let's just start right at the top here, because I think sometimes people hear the term Roth conversion and maybe they smile and nod like they understand, but if they're being honest, they don't really know what it means or what all it involves. So break down the basics for us, Adam.
Excellent. Yeah. So really, the government came out with what's called a Roth IRA years ago. And what it is, it's like a normal IRA. So a normal IRA, you put your money in. Most people get an upfront tax deduction. It grows tax deferred. And then when you pull the money out, it is taxable income in the year you pull it out. So they created a Roth account, and a Roth IRA, it is after-tax money, so you don't get an upfront deduction. You grow it tax-free, and then when you pull the money out, it's tax-free as well, not only to you, if you're married, to your spouse or to your beneficiaries. So imagine having an account that you can go pull money out of at any time that does not have any tax liability built into it. So tax-free is what you hear a lot of. So the conversion process, I get a question about this all the time. How do I get one? How do I get a Roth? While you're working, you can put money in and get a Roth. But a lot of folks didn't know that you can get a Roth by moving money from an IRA or a 401k and putting it into a Roth. Now, if you take money out, you got to pay taxes when you take money out of an IRA. So it's counterintuitive, but what happens if you're in a low tax bracket now? Pay the taxes on it, never have to pay taxes on it again. Use that money plus all the growth tax-free to you, your spouse, if you're married, to your kids, to your beneficiaries, everything tax-free. That's how powerful this can be, especially when the government, not if, when they raise taxes down the road, could be 5, 10, 20 years from now. When taxes are so high, you have already paid the tax bill on this money. You'll never have to pay the tax bill on it again.
Got it. Okay, so you dove into the why for us there, too, that tax-free growth. But, Adam, I've also heard some people say, I make too much to contribute to a Roth. So can you clear that up for us? Can anyone do a Roth conversion, or are there income limits or restrictions that people need to be aware of before they explore this option?
Yeah, great point. So two ways, actually there's really three ways to get a Roth other than inheriting one, but let's talk about the three ways you can get one. Okay. If you're in a 401k plan with a Roth element to it, you can put money into a Roth 401k. That's the first way. Second way is through a contribution. So contributions, you can do up to $7,000 per year. If you're over the age of 50, you can do $8,000. Now, if you're married and one's still working and the other one's not, you guys both can do up to between $7,000 and $8,000, depending on where you fall age-wise. So that's how you can get a Roth. There are income limitations and income restrictions there. It's over $200,000, so most people would be able to qualify for contributions, depending on where you fall tax-wise. Now, that's the second way. The third way is through what's called a conversion. There are no income limitations. There are no restrictions. You can put money, as long as you have an IRA or 401k, you can move money from those two accounts into a Roth, pay taxes as you move it over there, and never pay taxes on it again.
Well, now here's where I think it gets tricky for a lot of people, because when you hear the word tax-free associated with the Roth, I think it's easy to forget that the conversion part usually is taxable. So what should people understand about the tax implications of doing that Roth conversion, and how do folks typically cover that tax bill when it's due?
Yeah, I tell a lot of folks, while you're working and you're sort of in your peak earning years, because all we do at Wolf Retirement is we meet and help people as they get close to retirement and in retirement. So folks that are in their 20s and 30s, we're not giving too much advice to, unless they're clients' kids that are asking us questions. Mm-hmm. So, but for most of our folks, if you're nearing retirement, you're in your peak earning years, it does not make sense to convert, because think about it. You might be in your highest tax bracket you're ever going to be. and you take money from an IRA, put it into a Roth, that's additional income. And that income goes on top of all that other income you had. So it might push you up another bracket. Now, what I don't like to do is pay more than we actually need to. So the year you retire, that's where it makes sense to start to look. And we run the tax projections here. We actually look at your unique situation to see how much, if any, you need to move from the IRA to the tax-free Roth IRA.
Okay, so clearly there are some benefits that we went over, but also some costs. So that leads me to another important point. Just because you can convert doesn't necessarily mean you should, like you said, when someone's in their highest earning year. So talk to us more about situations where a Roth conversion might not make the most sense for someone.
Yeah, it might not make the most sense. I haven't found too many reasons why, because I don't care what you think about our government, whether you're on the right side, the left side, or in the middle. The math based on Social Security, Medicare, Medicaid, interest on the debt, funding our national defense, those key areas make up over 80% of our total deficit on an annual basis, 80% of the budget on an annual basis. They're not going to make any changes up there unless they absolutely have to, and they can either cut expenses or raise revenue. That's the only way they can do it. And so we can only raise revenue with growth a certain percentage. We can only grow our way out of a certain amount of this. The other has to come from increased revenue, which is increased taxation. It's not going to happen the next couple of years because the bill being extended recently with the tax brackets and all the income levels being extended. But down the road, we need to protect a portion of our assets against increased taxes.
Got it. All right. Well, before I let you go, I know the tax landscape is constantly changing, whether it's new legislation or projections that taxes could rise in the future. And so a lot of people are trying to be proactive. So how are those changes, both current and expected, influencing the way people are thinking about Roth conversions right now?
Right now, it was very important before. I've been talking about this with clients for years now, but right now we have another, at least 2 years, hopefully 4, of low taxes with the bill being passed. Because at the end of 2025, without the bill being passed, our taxes would have went up. So we still have time to do great planning to shift money from taxable accounts to tax-free accounts, pay minimum taxes now and not have to pay high, in my opinion, very high taxes in the future.
Absolutely. Well, Adam, thank you so much for breaking down this intro to Roth conversions for us today. If you're listening and this conversation got your wheels turning, and maybe you're wondering whether a Roth conversion might make sense for your situation, now is a great time to talk it through with a pro. And you can give Adam and his team a call at 904-232-8760, or you can find them online anytime at wolfretirement.com. Thank you so much for listening to Jacksonville's Retirement Coach. Don't forget to subscribe wherever you get your favorite podcasts so that you never miss an episode, and we will see you next time. Investment advisory services offered through Coil Capital, LLC, a registered investment advisor. Wolf Retirement Navigation, LLC, and Coil Capital, LLC are not affiliated. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining values. Opinions expressed are subject to change without notice and are not intended as investment advice or to predict future performance. Past performance does not guarantee future results. Consult your financial professional before making any investment decision. This information is designed to provide general information on the subjects covered. It is not, however, intended to provide specific legal or tax advice and cannot be used to avoid tax penalties or to promote, market, or recommend any tax plan or arrangement. Please note that Wolf Retirement Navigation, LLC and its affiliates do not give legal or tax advice. You are encouraged to consult your tax advisor or attorney. Annuity guarantees rely on the financial strength and claims paying ability of the issuing insurer. Any references to protection or benefits or lifetime income generally refer to fixed insurance products. They do not refer in any way to securities or investment advisory products or services. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and not offered by Coil Capital, LLC. Florida Insurance License Number W016816.